What is going on, everybody? Welcome on in and happy Wednesday. We are live here and we are looking at crude oil, which today just made a new low on the year and is now coming down to points that we have not seen, to levels we haven't seen since late last year, essentially a year ago in late 2021. That's what I want to kind of talk about first. At least for today, there's a lot of stocks that we could be paying attention to that may have seen their highs for the near to mid-term. We can also take advantage of if maybe you're using hedges and whatnot, and then put yourself in a sector that is definitely looking weak. But on top of that, we also want to talk about what is going on market-wise. We've had some good action the past couple of days. Today's more of a consolidation kind of chop day because we're kind of flat. But there is some massive moves going on right now in the bond market that I think are really important to talk about. But first things first, I do want to shout out the channel sponsor for today, Chart Prime. Really quick, they're still doing that holiday promo for 40% off. Now, Chart Prime is more than just kind of a trading service. It is essentially algorithms, 6 different indicators that you can add to your charts on TradingView, integrate them right in, and get stuff like this to pop up, and essentially have a computer chart things out, identify patterns, possible reversals, all that good stuff. And by no means is any pattern reversal, any of this stuff 100%, just like we always talk about and just like everyone for the most part understands as you've been around this game for a long time. But it's something that I have been paying for myself past couple months and I've been using, and it's actually pretty cool. And of course, again, like I said, nothing is 100%, but it seems like a great community, a great platform. Also have a Discord group with a lot more that comes from in terms of signals, in terms of a whole community, and a lot of tutorial videos and trainings that are meant to help you. So again, link will be down below in the video description box as well as the chat. And thanks to Chart Prime for sponsoring the streams for this week. So let's dive into oil. I want to kind of cover this a little bit first because that's kind of like the title of this, but then we'll get into the market and all that good stuff. The reason why is because if you were to take us back to the pullbacks after Russia invaded Ukraine. Okay, circle that right there. When oil pops up, goes to about 130. This is WTI crude. Goes to about 130. Then it comes down to sub $100. That was like, oh my gosh, buy the dip. Oil's going to 150. Oil's going to 175. Oil's going to 200. And Jim Cramer is even one of those guys who's even quoted it back in June. Back in June, I just saw an article today. Back in June saying this is the dip to buy. Now, the thing is that we want to talk about when it comes down to, it's actually funny because you look around at this time, a lot of analysts, a lot of big names, whatever investors and whatever people who you would trust, right? Were saying buy oil. And guess what? It bounced. But ever since then, ever since late May, this thing has been just down, 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 right? You can't deny that it's been completely downtrending, and off those highs, the thing is down massively. Let's look at the thing. The thing is oil. Let's look at where it is from those highs, or let's just go back from those May highs, or that was actually June 13th. So the mid-June highs to where it's at now, it's down 41%. 41%. Pretty incredible for the easiest trade of the year, for what everyone was saying was going to 150, 200, 275. Like all these crazy price targets go back, and it just shows you, right, how when the crowd is all pushing one thing, you got to make sure you're paying attention to the other side of things, and you don't want to be just completely blinded by the fact that, I'm going to just trust this guy. Now, of course, this is a signal for recessions. It's actually pretty concerning how oil has been getting annihilated like this. And there's a lot more reasons, a lot of other stuff that's going into it. All right. And then, of course, on top of that, with China, with their COVID policies and kind of like opening back up. What we've been saying, China's opening back up every 3 months, I feel like. But you would think, right, everyone's like, oh, that's bullish for oil. Guess what? Ever since that kind of news has been breaking, oil has done nothing but go lower. So it's popped a couple days. There's been some news here and there, but it's gone lower. So I think it's kind of funny to look back on this. It's kind of one of those like the trade of the year, right? That really wasn't. If you're just looking at oil. However, jump to energy stocks, jump to oil stocks, and one of the most well-known is ExxonMobil. I just want to mention this really quick. ExxonMobil well exceeded those June highs. Actually, back in March, ExxonMobil was only up to $91. Pops up to over 105 here in June, and then even higher, went to about 115 or just shy of 115 just like a week and a half ago. So despite oil coming down, a lot of the oil stocks have still had some solid days or some solid months over this past year. So the difference between oil and oil stocks has been pretty substantial because oil's done one thing, whereas oil stocks have seemingly done a completely different thing over the past couple of months. Then you look over at XLE, the energy ETF. Let's pull this up. Let me just make sure this is raised up so you can see the price points in bigger letters or bigger, text. XLE, kind of a similar situation. This thing popped to highs in June, pulled back a lot into July at about a month, but then it's gone ripping right back up and hit even new highs on the year, back up to 95. But again, same deal, right? The energy stocks and a lot of the big oil stocks or oil companies are inside of this ETF or have the heaviest weights in this ETF. That's why we mention it. But it seems like that narrative has completely shifted now. It just seems like the past week and a half, especially after these big moves to the downside here in XLE and in some oil stocks, it seems like unless the stock market's about to go to all-time highs and oil is going to kind of hold up and not plummet to lows or plummet even lower than where it's at, well under $70, it looks as if these are finally starting to catch up in terms of the bear market this year. It seems as if they're starting to reverse. And the question will be how much they have of downside versus right where oil goes. The thing is, I think that everyone was kind of projecting or thinking or figuring the oil would stay higher for longer. Now that it's like coming lower and lower and lower, and especially after the China situation and oil is still going even lower, you're starting to see a lot of people rethink that. And I think the pricing in and the expectations of earnings and so forth that some of these companies would do a lot better with higher oil prices. Now we're like, wait, what if oil prices don't stay high, or what if they keep going lower or hover around here? What does that mean for some of these oil companies? And I think that's what you're kind of seeing is being digested now. They could have a lot more to go to the downside, but something to keep in mind as, of course, the trade of this year that everyone was so bullish on, right? Despite the overall market was so bullish on oil, it's done exactly the opposite realistically since these peaks. And again, I'll go back even a couple of weeks, about a month. Back in here, there was a lot of people saying, I'm loading the boat on oil, I'm loading the boat on crude or ETFs, oil stocks. And that was only about a month or two ago. And what's happened, right? We've been just a steady stair step to the downside, and a prior area that was support back here in March and April became resistance in the mid to low 90s. And that was our last pretty big rejection to the downside. And now here we are in the low 70s. So something that I think is interesting. I think it's kind of comical. Obviously, it's not comical if you're getting destroyed and burnt by this stuff. I've got burnt in many other ways this year. But for those who kind of follow the crowd and follow the analysts, right back up in here, that oil was going to $200. It seemed obvious and it seemed like it made a lot of sense back there. But it's just kind of funny how things work out. It's never that easy. Or at least we think. Just like we thought SPY was, it can't be that easy, right? SPY not going to just reject off this trend line. Well, guess what? SPY is doing just that, and SPY is actually rejecting here off this trend line for this year. We got a kind of an uptrend I built in. Here's the daily chart for SPY. We're at the 390 zone from about 389 to like 393, something like that. It's like this zone that I have drawn in. Prior area of support resistance for the past, like 6 months. Also uptrend from these lows, or from mid-October, we have an uptrend on SPY as well. So under 391 under 390 gets really interesting in terms of downside, as that would be a clean break, also breaking down below this zone. So that's where we get interesting, at least on SPY. But hope everyone is doing well, and we're going to have a nice little stream here into the last hour of the day. Flippa's in the house, the legend, what's going up? Not much. Today's been a pretty chill day. I think we're up like $100 or something like that in the Webull account. We can just double check and check it out. No positions right now. Up 106.92 on the day, 1.5% in the portfolio. It's pretty good. Nothing too crazy. We can talk about that. Maybe I honestly like doing the review videos of trades. They're kind of fun to do. Maybe I'll do that tomorrow. But let's see. Outside of that, we were kind of grinding back after the stupidity of last week. We made some corrections and just, hey, there's no reason to try to make it all back in a day, right? Just kind of, stack up the wins and do what you were doing the weeks before that was working, and that's what I got back to. It's working pretty nice. No trades in the small account today. Just to be honest, didn't see too much that I liked, and it's been choppy. Go back to SPY here, which looks like it might actually try to go down and make a push to test the lows of the day here into the close. It looks pretty weak, but it's just been choppy kind of off the, we gapped down in pre-market down to like 391, popped to 395, a little over 395 today. But since then, they've been this like $3-4 range, which hasn't been much. So that's the deal. However, if you haven't been paying attention to the bond market, I mean, everyone's talking about, I mean, not everyone, but I've just been seeing a lot more chatter about this lately. Take a look at this. Here's TLT. TLT is about to hit 110. It's actually pushing up. Look at how strong TLT has been today, by the way. Incredible strength. Let's look at the daily chart. TLT just, how many gap ups do we have in the past like month of TLT? It's insane. Gap ups. It's gap ups galore. Gap ups galore. It's like everyone is trying to get into TLT hand over fist. Everyone's plummeting or just dumping money into bonds, it seems like, as of late. When no one wanted to touch this stuff, earlier this year, people are just, dumping money into this stuff now. And in turn, yields are coming down. So check this out. 10-year is down 3.5%. The 10-year yield is down 3.5% today to a 3.411% yield. This is dropping below 3.5 pretty substantially, and looks like wants to make a beeline for 3.2% next. So here's where things are getting a little bit more interesting now, and kind of like, the question marks are popping up. What the heck is going on here? Because this is dumping off. Well, not what the heck. I think we can explain this to some degree. Of course, you can try to rationalize all the time, but I think the general gist is that bond market says, hey, Fed's over tightened, or Fed may have tightened a little too far. They're going to have to kind of slow down and cut rates or whatever sooner than they thought, blah, blah, blah. Or we're going to have a recession at some point, and the bond market's, many months ahead of time, is pricing this in ahead of time before the Fed. And that's how the bond market generally tends to work throughout these economic cycles. If you look back over history, the bond market tends to lead the Fed. So yields are pushing up. Now we can kind of see the end in sight. After Powell's comments like last week and whatever, you're kind of seeing that they're getting ready to, at some point next year, pause and potentially cut late next year. And they're probably going to say that we're not cutting anytime soon. However, the bond market might be calling that bluff, or just pricing in ahead of time whenever that time comes, that, hey, you're going to need to cut at some point because we're going to have a recession, yada, yada, yada. Now, do I think this is like insane? No, we could easily bounce right back up, right? Whatever. But this is notable to see this trend play out with the stock market, because we haven't seen this. We have not seen the 10-year this year during the downtrend in the stock market, the 10-year yield plummeting like this, and the stock market also dropping. So it's been this, today was a pretty notable day of downside in the 10-year. Has the correlation been day to day, second to second? It had kind of felt like it was like a month or two ago. That correlation was like a little bit tighter in terms of like day to day. But generally this year, it hasn't been day to day. And why? You go back to August 2nd. August 2nd of this year was the bottom where we had that big reversal day on the 10-year. The stock market topped out and then reversed on the 16th. So there was about 2 weeks of time that the 10-year still that actually inched up while the stock market inched up. So they're not completely inverse all the time. And then eventually the stock market kind of pulled back. If that correlation is going to stand, which I don't think that correlation is going to be perfectly, the same exact way as it has. All correlations or all of these things will come to an end at some point to some degree. But this is really interesting, because if the bond market is telling us, and this correlation is going to stand, right, still, or this general correlation will stand throughout the rest of the next, couple of months, let's just say, then what this is telling me is that this is a buy the dip. This 390, it's telling me that this 390 might actually hold on SPY, and this is a buy the dip. That's what it says. Am I going to bet on options right now? No, but that's what it's saying. If, of course, this correlation continues to hold. So that's where it gets interesting. DXY, the dollar, not at lows, but it's weak again today. But notable, the 10-year is getting annihilated, and that's just because I think you're seeing a lot of money going into bonds now. People are kind of playing for that flight to safety, that trade of like, okay, well, if we have a recession, that means the yields are gonna come down, and there could be a lot of money to be made on the backside of this as well. Hence why I've been liking the TMFs. I think when you look at TLT, and I had a period of time where we're playing calls and whatever and stuff, got stopped out a couple of times on that, trying to play it, but really we're just fighting this trend to the downside. Eventually that reversal was going to come, and of course we're getting it now, and it's pretty substantial off those lows, but I decided just to hold the shares of TMF, which is the 3X ETF of TLT, and I don't have a reason to sell it. Yeah, it's gone up a lot. Like, is it a bad idea to trim some off? No, like I don't think it is at all. To me, I'll just sell covered calls, and the covered calls, the options will be a little bit more pricey, so you'll be able to get a little bit of a higher premium for that as we've gotten some momentum the past like month or so, which is good, at least in my view. But pretty insane move to the upside here on TLT and TMF. So this is TMF, the 3X bull ETF of this. So the reality is like, okay, if TLT kind of rips up even further into next year, well, TMF may go on a run from, went from sub $7, maybe it goes to 15, 20 bucks. Could go for more if we have a really bad recession. Who knows? But that would be an incredible trade, or at least kind of investment, or whatever you want to call it, swing or big picture macro economic kind of play that, number one, protects some downside. Because of course, my thought is that if we do see that, like, you're still probably going to see, pressure in stocks. Of course, maybe it's not like the entire stock market. Maybe it's just select sectors, tech, growth, which they've been weak as it is now. Doesn't mean we have to go to new lows, right? If we have a recession and like it gets kind of bad, if it gets really bad, I mean, who knows? It could be even worse. It could have more of a crash, dynamic playing out at some point if it's really bad. And who knows if other things in the system break, like, there's a lot of things that could happen, I guess, in theory, right? But this is almost kind of like that recession protection, play. Is it a good buy here? Like, I'm not going to say that it's a good buy here. However, I'm not going to sell mine from a lower average. I have an average, I think, somewhere in the nines, low nines, I believe, which is not great, but there was no reason for me to sell it on that way down. So I was going to hold on to it. Now sell covered calls, but that's an insane looking move off of those lows on TMF, TLT, and stuff like that. The reality is, for me, it's like, if it goes 100%, and my cover call gets taken out, all right, that worked out. And, I got caught a decent chunk of that move. I'm fine to just leave the cash or look for something else. So we'll see. We shall see. Let's go back to SPY. Oh yeah, but so back to that idea, right? Is that, if this trend continues, what is it setting up for? What is this? What is it? Maybe now, just speculation, right? I think the 390 is key. The 10-year under 3.5%, the 10-year yield under 3.5%, and SPY under 390 and staying below. Like, if it just dips down below and then bounces back up like next week, okay. But if next week comes, we get FOMC, we get CPI, SPY is end of next week under 390, and the 10-year is under 3.5%, boom, that now means that, to me, that correlation is no longer valid. I'm not going to care about what the 10-year does and what that might mean for the stock market. Not going to care, because that's telling us that we've gone from the shift from inflation worries, oh my gosh, to now recession worries. Dare we even say, deflation worries at some point? Like, that's the more of the bigger concern, and that's why the bond market's doing what it's doing, and the stock market's saying we're more concerned about earnings, we're concerned about deflation, we're concerned about the recession and overall economy versus the bond market and yields and what the Fed's going to do, because we don't really care. That gives you maybe a window of maybe the stock market is like kind of just weak as hell in a window, and then eventually, if the Fed decides to turn that printer back on because, like Powell said, they over-tighten and they have the tools to kind of fix things, then that would be more so your signal to get back into stocks at some point. So to be honest, like, as bad as it sounds, like, we kind of, if for traders and to make money off the volatility, as we're kind of seeing this, thing play out, you want these massive moves. You want the Fed to almost over-tighten in a sense for, a big move down, which could be an amazing buying opportunity at some point next year for a lot of stocks, or who knows, maybe later on than that, for a lot of stocks, just sectors, for, investment portfolios. And then if the Fed does the same cycle and repeats again, right, you kind of are going to see the same thing play out, and the markets can have a nice run for a couple of years after that. So it's kind of just these almost, I don't want to say easy to predict cycles, but these big picture macro cycles, like, it kind of makes the environment, a little bit easier, because now we have a lot of the roadmap from what just happened over the past couple of years, and we can compare and contrast what's different, what's similar, and then what does that mean, right, for the market and for stocks and for sectors and for all that good stuff. So a lot of stuff to unpack on a lot of pretty long, introduction, I guess, in today's stream. And now we can kind of start watching what's happening, at least market-wise. This looks kind of weak on SPY, although it's at support. Right now, I kind of like that as a put play for, I think, QQQ. Yeah, look at this. I like that as a put play for into the close, maybe on the Q. He's broke this trend line. So stop loss would be like 280, a little over 280, 280.25 maybe. Looking for, down towards maybe 279, something like that. We'll see. I'm not going to be touching it just yet, but maybe I will. Probably get taken out my covered call. You can roll on TMF, right? TLT's going nuts. 0 days to econ. Yeah, today that's what kind of felt like today was a kind of a contract after 2 big trend days, right? 2 big days in a row, Monday, Tuesday, where the market kind of opens up, stays below VWAP, and just kind of flushes all day long. The past 2 days, pretty much. You're going to get these consolidation days, and I'm not surprised. It's Wednesday. The closer we get to CPI on Tuesday, the less kind of expectations I would have for bigger moves in the market. So take that as you see. Just be careful, right? Sizing, I guess. Why maybe next week expiration contracts are not a bad idea. Just to kind of minimize the time decay and stuff like that. August says he's not looking forward to next week economic reports. Yeah, it's gonna be a interesting week to say the least. Hit my max loss, just project. Yeah, and it probably was. It seems like it probably was because of the chop and because of the decay, right? I would think, unless you're absolutely perfectly scalping these short-term, couple minute moves, and there were some decent moves to play off of, but unless you're doing that, it seems like it was probably because of decay factors or reason why, today was a red day. But you have a max loss, and it's there for a reason, right? Best rules. That's good. Good to hear. That's one of the best rules you implemented. That's good. Boom, boom. So today, the Webull for me is up $100. I didn't touch a small account just because I just didn't see anything that I really liked to the point where I was, willing to put the small account into something. So I played a couple of smaller things in the other Webull account, the personal account, I guess. But it is what it is. So, to be honest, this is puts. If you're going to expect the next 40 minutes of something, you broke this trend line to the upside on the Qs. To me, this looks like puts, but I wouldn't have a huge conviction, to be honest, in this either, because it hasn't been a super trend day. It's been a choppy day, and so these tend to be easy fake out opportunities on choppy days where you have a decent trend that looks like it breaks, and then you get a complete reversal back the other way. So something I'd be careful with on the Qs. That's on the Webull account. That was on Webull. Let's go to TradingView. This is back to TradingView. SPY is breaking down. It's about to test lows of the day. Only problem that I have with that as well is today's lows line up pretty close with yesterday's lows. So you kind of got some decent support. You're kind of holding that that area. So I wouldn't be loving to short this thing at today and yesterday's lows. You got found buyers there a couple of times now the past 24 hours. So maybe it's not worth shorting this thing into the last 20 minutes of the day. If anything, yeah, I would take it. Honestly, if anything, now you can see how you're kind of conflicting views. The chart might say, this looks pretty weak, but then your head says, and then you're when you start second guessing yourself and you start saying that, it's a gamble and it's not worth it, in my view. Kind of talk myself out of that. If I had to take something, if someone said, okay, you must take a SPY put or call position right now into the close, I would probably take calls right here. But that's just me, and that's chart wise, we do look weak, but because of this chop today, I would say that I wouldn't be surprised if we end up closing up towards that VWAP or make a push up towards that VWAP, which is about $1 pop into the close. Nothing huge, but that would be my speculation. Speculation right there. Force myself to listen to the rules. Yeah, when you review them too in the morning, it could be helpful. I think at least. I've been reading this book slowly, very slowly. Every day I try to read a little bit more, just so that I'm maximizing the actual actionable stuff in the psychology book. It's called The Mental Game of Trading, I think, and it's by Jared Tendler. And it's kind of following through and mapping a lot of the things that you're kind of seeing is pretty helpful. And so I've got some pretty good charts and stuff I'm developing myself of what happens on what's unpacking the red days, when you do stupid stuff, actually understanding the mindset, the framework, why. Ask the question why 10 times, and I guess it's probably not 10 times, but if you ask the question why enough, you'll get to some of the bigger roots of why you took that trade, why that was the case, why I, was in that mental framework, why I was even there, you know what I mean? So that's the take that I got. Stuck on TQs. I wouldn't be. I don't think that the TQ play is still a bad idea. And here's my, let's look at QQQ and just get a feel. By the way, there was some good volume that just came in on that candle. Let's jump back to Weeble. Yeah, that 5-minute candle. There's been some decent volume, a little bit, but I guess you're into power hour. So you're kind of seeing that it looked like that was a short as we broke that trend, but it seems like we're trying to catch a bid and some buyers are coming in. So you might get that kind of weird fake out back to the upside move and just pin you right under VWAP by the end of the day. I wouldn't be surprised. Qs are still above the 50 SMA and, kind of in this area that we've found around 280 to be an area of support this past couple of weeks. But kind of like gliding a little bit lower. It's been a little bit weak compared to SPY, it seems like. Because SPY has a higher low set up almost. SPY's kind of had a higher low compared to what we had back here on the 17th of November, where it's QQQ. Go back to QQQ. It's kind of making a lower. Today it made a lower low over the past, couple of weeks since that early November CPI pop. So we've given back some of the move, or pretty much most of the move post CPI day of like 2 weeks, 3 weeks ago, or actually no, it's more than that. It's almost a month ago, 3-4 weeks ago. We're about to hit the next CPI. But yeah, I still don't think it's like to get that signal of like, oh, okay, we're going to lower low. Look at SPY to get like the lower low situation. I mean, I want to see this thing breaking down below 380. Small gap to fill right here from like 381 to 385. That's actually not small. It's pretty decent size. So if we do break this trend line, maybe today's kind of your consolidation day. Great. Does that mean tomorrow has to be a big mover day? Not necessarily. But if we start to break down tomorrow and have a decent downside day and break 390, then I would say that there's room down to the low 380s here. So don't be surprised if that hits like, this week. And especially if the sell-off progresses Thursday, Friday, people are like, whoa, I don't want to hold anything into next week. I wouldn't be surprised. But what will be really interesting to see is come next week, based off the 10-year, is the 10-year telling us something? Based off bonds, right? Is that telling us something? And if we end up in this area, do we catch a bid? Does the market like a CPI and the Fed? And are we going to snap right back up? Like that would be the question. Because if we don't, now guess what? We can't use the 10-year to kind of guide us anymore. It's kind of doing its own thing. And that's more of that recessionary trade versus kind of a interest rate hike trade, even though it kind of essentially all factors in, but it's more of a fear of recession, fear of what the Fed has to might have to do next year, and concerns with the economy, earnings. So that is the take, but that would be the spot. So if we start blasting below 390 on SPY, oh man, I think that could offer a short-term momentum downside trade down to about 380-ish, even low 380s. 50 SMA will be down there as well, and the gap to fill. So it would make sense. Don't have to force burn. Yeah, that's what I find myself doing. Like I could have, you could easily look into the close. Like even this. By the way, it's actually in speculation of this being a fake breakdown here is actually panning out. But even that, let's say you went long right at 279.81 on the Qs. It's up 30 cents. I mean, scalpers maybe, but zero data expiration options maybe. But even that, in the last 30 minutes of the close, time decay is just bleeding those things out. So it's like it's not really worth it. There's not too much to do. Like in that situation, there's just not much that you can really do, in my view, because it's just a lot of ways to get burnt, especially when the moves are that small. Constant long average on Soxwell, $8 to $9 cost basis right now. Yeah, that's up now. What is it? Let me just double check where Soxwell's at. It's at 1170. Let me just pull up the Robinhood account. So the Robinhood account's actually doing pretty well this week. I sold. Oh yeah, look at these Walmart puts. I'm gonna hold that Walmart put through Powell because it was meant to be a hedge. And everything else is long. Now, does it seemingly as of late market going down mean that this portfolio goes down? Even though I have a lot of longs in here and there's leverage ETFs, the TMF and AGQ are like kind of somewhat disconnected because like they're kind of doing their own thing. Like stock market could be down, but AGQ, let me just make sure you guys can see what I'm looking at. AGQ, let me pull myself away for a second. AGQ, let's zoom in if I can do that. Boom, there it is. AGQ is a leveraged gold play, a silver play, and then TMF is essentially a leveraged TLT play. So the position that I want to build the biggest is JPI, and then I'll maybe build some other dividend plays as well, just for a little diversification. But yeah, it's done well. I had a ExxonMobil put out to also have, it was also a January put position, but the thing was up like 60% in like a day and a half. I was like, I'm just going to take this off because it was just too much in too short of a time. Maybe if ExxonMobil pops back up, there could be a reshort opportunity, but I don't even like, I'm not going to fight that after the moves we had this week in oil and ExxonMobil. I mean, it could totally get a little bit of a bounce back. And so at that point, I'm just going to take the gains on it. But I'll hold the Walmart put. It's a small thing. It's this very small position, but it's at least it's some downside protection. Some, if the market does not like CPI and Powell. Just saw a Walmart CEO piece of news came through. I just saw on my phone, I think today. I forget if it's on Twitter or something. And he said, I think he said like they were expecting very good shopping numbers or customers to be shopping after Christmas time. And it's like, you have no idea, dude. You have no idea. We'll see what this. My speculation is that that's not going to be the case, but we'll see. Reason why is because I think we're going to start seeing the effects of the crazy high credit card debt we're seeing right now. A lot of the effects of that stuff will start to play out. I think into next year, post this Christmas time, we'll see. But Walmart might not be the best stock to short if you're playing the retail or you're playing like this recessionary trade of no one's going to spend money. Like, there's probably better higher end companies and higher end brands you can probably look to short versus a Walmart. But same idea is I don't think the consumer is going to be that strong next year. This is my speculation. We'll see. But yeah, that's the deal. I feel like I've been saying that a lot lately. But yeah, the covered calls. Like the covered calls in this portfolio, TMF could get taken out. I sold an $11 call for next Friday. So, I mean, you still got plenty of time. And it's up a lot. Still got to go about 80 more cents to even possibly take me out. But you can always roll it. I might roll it if we get up to that high. That would be a pretty impressive move, I'll tell you that, on TMF. If we were over $11 by next Friday, well, it could because of, let's say, what happens on CPI. We could easily be there. Then I'll probably roll. I have 200 shares of that, so it's like $2,000 position right now in this portfolio, which is kind of a lot. But I'll probably roll a contract. Well, I only have one. I'll probably roll that option out like another month. And then if it gets taken out, it gets taken out. Then I'll have the last 100 shares to kind of be my ride on the way up if we keep going up and just sell covered calls, way out the money on those. The thing is, these were kind of expensive the options were super cheap. There was no one touching these things. Now, let's go check out TMF options. Now, if I go to sell a covered call for, let's just say January 20th expiration time frame, now you can go out and sell the 13s. You can go sell even the 15s and get paid $5, right? It sounds dumb, but hey, that's like 50% from here, and you can get paid a few dollars as almost a dividend and some minimal, it's not much, but it's some downside protection. You can get paid a few bucks to do it. It's not a terrible look, right? So now they're getting to be a little more pricey, which is good. I think even closer to the money plays as well, right? $13, even to $12 for 35 cents for another 20% pop. Sure. Like this starts to become interesting. I think. Let's jump back to SPY. By the way, that speculation that we had like 15 minutes ago is seemingly panning out. But not much of a huge move, but in this little wedge that you kind of have setting up like on SPY. From the highs, got lower highs, downtrending, and then you got some nice support here at like 392.25. So it bounced, and now maybe you sell off a bit here. It's not much of a move at all. And I think maybe tomorrow we can look for something potentially bigger. Let's see what the economic news for tomorrow looks like. What do we get today? Today we had productivity. Yeah, tomorrow's jobless claims. That's why. Here you go. Tomorrow's jobless claims. So tomorrow morning should provide some opportunity off of maybe a spike around, or a spike or a dip, depending upon how this numbers come in. So we'll see what happens there. And then we got some more data on Friday, which should be interesting to see how that plays out. Markets do react a little bit to this stuff, but I wouldn't expect too much, on Friday. But really tomorrow, the jobless claims could be interesting, right? They're expecting 230,000 jobless claims. Last number was 225. So we'll see what we get. Let's see if I can go back to last week. Can I go back to last week? Yeah, last week. Let's pull these last week numbers. Yeah, last week number jobless claims to 225. They were expecting 235,000. And we got 225. So now they're expecting 230,000 on that. So we'll see where that comes in. If it comes in, hot or not, we'll see. Could affect the bond market, could affect the stock market somewhat substantially. It seemed like we got a pretty big reaction off of that, at least initially last week. So that's what we have set up for tomorrow, which I think could be a little bit of a spark because we're kind of just in this consolidation phase now. It's just kind of boring. So that could be a little spark, a little something. Ideally. Don't want to see a close below 3925 on SPX. Let's check in and see where that's at. Kind of right around the lows of the day almost. So we'll see. But yeah, I mean, I to be with the how we reacted off the last jobless claims, it won't look great. Maybe if we come down and close under the lows of even yesterday, that would not look great. But it could easily be walked back after that data for all we know. So I feel like it's a wait and see for now, for me at least. To try to be a CFA. I feel like it would be too much. I don't want to say it in a bad way, but I feel like it would be too much effort at this point for me to want to do that. CFA, yeah. I don't know. To me, the way that I kind of see it, and not in a bad way, this is not in a negative for people who want to go the more, not so the official routes, but to me, it's it could be good for, it probably is very good for a career and whatnot. However, the way I kind of view it is you don't need that to become a good investor or a good trader or this or that. That's not necessarily going to help you. Yeah, you're going to learn about a lot of other stuff that is important and whatever. Yeah, especially if you're looking to advise others and whatnot officially and build a business around that potentially. But to me, I don't really see myself really have an interest there right now, and I just don't think it's worth it in my view. But that's just me. Tomorrow's idea for me, retest bounce on TLT for a day trade below 109 with stop loss. Let's check on TLT. I would wonder if the job numbers, the jobless claim numbers at all, right? Yeah, 109 tried to be an area today. I wonder if that stuff will make an impact or will do any damage to the TLT tomorrow. So be careful with that, which will get a good sign off the open. So if it's too volatile, maybe it might not be worth it, too choppy, but we'll see. Scaling into puts if we close below 3925. All the information is available online nonetheless. I mean, yeah, if you want to learn pretty much anything these days, you can pretty much find it online. It just comes down to official certifications and stuff. It's how you have to go through a system or whatever. But in my view, I don't really see a necessary need for that type of stuff. Although it does look good and it's makes you look official and professional, I guess. But tell my clients just buy a deep OT 0-day to expiration. Spy call. Yeah. That'd be hilarious. If someone was actually giving legitimate, financial advice on playing short expiration spy contracts. Never spent that much money on a degree. I like the idea of license, real estate license. Yeah, those could be cool. Yeah, that's going to be cool, and it's not going to cost what it costs. No, and I say it too. I mean, I say it all the time. I've said it multiple times, and I don't mean this in a derogatory way towards a college degree, but that was the worst financial decision that I made in my life. But I was 18 when I made the decision. Now I'm 24, and I'm like, yeah, looking back, that was the stupidest thing I could have done. Like, it was... Now, I could have probably gone to... No, looking back, if I was to do it now, but you're in a different situation, right? You have other influences at the time. You're thinking differently. I thought I wanted to do something else at the time. So I thought I wanted to go a certain route that I ended up saying, like, you know what? I don't really actually want to go this route. Of course, it's an expensive lesson, but yeah, that's what I say. And it's, not a knock on going to college, because there is value, I think, but in a cheap manner, right? In-state schools, community college for the first 2 years, then transfer somewhere else, right? There's ways to play the game, but back when I was going through it, not necessarily saying my parents didn't know, but the influences in my high school, my town, were very, very heavy on teachers. Like it was like, you go to this school. I didn't go to a private, I went to a public high school, but like, you go to this school, and this is, it was supposedly, a fairly highly ranked school in the state of Connecticut or whatever, whatever the stupid numbers are. And by what standards, I don't know. But a lot of smart kids, a lot of kids went to Ivy League schools in my class, and it was kind of cool. But like, it's kind of cool, but also they're still probably paying, out the whatever to get in and to go to school there. But expensive, man. Way too expensive. So I don't recommend it. I would not do the same thing that I did back then if I had the chance to do it all over again. But then again, right, there's a lot of other influences at the time. And who knows if I'd even be here right now if I didn't go to college. I don't know. If I would have thought the same way and got into the same things, like, who knows. Peace, August, heading out for the day. Father duty calls. Humans easy to manipulate. You can get them to believe you're professional just by the way you speak. Yeah, it's true. Or you just put on a suit. I mean, there's a lot of guys here there's a lot of people on social media and whatever, that if you just have, you want to build an image. Like I don't want to say I feel bad about it, but like, because I don't really care. It's, do whatever I want to do, I guess. But I feel like even in just my general in my life outside of like whatever, I don't dress very like professional at all. I'm much more of the, t-shirt, shorts kind of guy, like for the most part, which I feel like is something I should probably do. I could do a better job of in my own life, but I don't think that necessarily always comes across as very professional, but it is what it is. I don't really necessarily care that much. So do whatever I want to do. At the end of the day, doesn't matter. Hope everyone had a great trading day. Yeah, I mean, you would think with puts, but like to be honest, unless you shorted the opening pops, it's been just a chop day, so it hasn't been the best of opportunities, I would say, today intraday. But I had one trade. It was IWM. Looking back, it was really, I guess I had two small ones, but this is a good one. IWM was showing relative strength, at least it kind of is. Here's the trade, and I ended up stopping out as we got rejected here and started to fall back off. So it didn't like completely work out to the exact perfect standards, but I ended up taking a decent chunk of the gains anyway. So I was looking at IWM, and I saw that we came down a couple wicks this morning and held yesterday's lows with those two pretty big wicks. And I was like, okay, that's pretty good. And I saw that, and I'm like, okay, SPY's been down a couple of days. We've been down a couple of days in a row. We're kind of into some support. I would expect some bounce around the low 390s here, potentially. SPY looked like it was bouncing as well. And so then I saw some relative strength in IWM. So like, okay, I'll play IWM versus playing SPY to the long side. And we got a decent move. I got in somewhere up in here, and my stop loss was under those lows, and my target would have been up towards about 183 or 181.63. We got to 181.48, so we got pretty darn close. And then I think on this candle, somewhere in here, I just ended up taking the profits because I saw it was rejecting back to the downside. I just didn't want to hold this thing all the way back down, which I ultimately kind of would have done. Then it came back to my average and bounced a little bit, but I ended up taking off somewhere up here. This is the reason why I had this charted out. It was just to kind of give me a visual guide of a 2-to-1, and ended up taking instead of a 2-to-1, end up taking like a 1.3 to 1 risk reward in the grand scheme of things. But that was the only like real notable bigger move of the day. And that was really it. So it was calls. Actually, yeah. So it made money in calls, technically, even though we're down. I had a firm puts, but like essentially stopped out for break even or slight gain, like $30. I don't even know. But just didn't like it was actually right before the big move on IWM. We got a flush to lows on a firm. I was in puts looking for a continuation as long as it held below VWAP. I ended up taking those off somewhere in here, and then we ended up I would have gotten stopping out if I didn't take them off for a slight gain, and then it ended up just kind of blah. A firm looks pretty nasty, and there's just been not much action here. If anything, it's to the down. Well, there actually has been action here. By the way, the past 3 days it's been destroyed. But at some point, that downside extension is probably going to chill out for a bit. There'll be a bounce or somewhat of a consolidation phase, and then the moves are kind of, as the stock starts to get down to like, $10, okay, it's not as fun to trade anymore. When it was $20, $30, $40, it was more fun because it could, a couple dollar, options will move a little better. Now it's like, couple cents, you're talking about 20, 30 cent moves, which are still a decent percentage. 5% down day on a firm right now is down 60 cents. You would get 60-cent moves in like an hour or two, a few months back, it seemed like. So the moves start to slow down, so it starts to become less of a interest, less interest there for me to trade it, I think. University of Texas undergrad, UCLA grad, never going to trade, experience learning something. No, yeah, and those are pretty, especially now. University of Texas is pretty freaking tough to get into. That's pretty impressive, man. I mean, I know now, I say this now, I don't know, like I guess, but like looking back, my brother goes to UGA, Georgia. I went to Penn State, you can probably clearly tell, but I went to Penn State at the time, was like a fairly easy, I don't want to say easy, but like for me, for my grades and stuff, which was like, I would say above the average kid, but like not super, exceeding, expectations, generally speaking. Penn State, like I feel like I got in fairly easily. But I was looking at like my stuff versus my brothers and sisters now are in school when they were touring a couple years ago, colleges. I'm like looking at these like for things of like their scores, their average. I'm like, I was nowhere freaking near any of that SAT, GPA. I didn't take that many AP classes. These schools are not easy to get into now. The big state schools that, a lot of these big programs, like they are hard to get into. TSM looks a good short here. Let's say, look at TSM. Semiconductors. Let's take a look. Let's look at the daily on this guy. Don't like that we're in demand zone, but the buyers have been lackluster. All the news has been come out the past few days for TSM. Buy the rumor, sell the news. It does. And look at this. I mean, this is that. I'm glad that you mentioned it because I have been watching like the other semi plays, and I haven't been watching this one specifically, but this is a great one to add. I agree that like I get what you're saying about we're at demand, right? But look at the freaking gap below. I mean, you've got a couple of dollars of potential unwind that we could see. So this one might be a really good one to have on the list for the rest of the week in my view. I'm not going to maybe swing it, but for like an intraday, that could be a good idea. That could be a really good idea. I'll mark that one down just so I have it logged for potentially tomorrow. And hey, under this level, under today's low, like 78, 60, something like that. Yeah, I mean, I like that a lot. You got a lot. You're kind of starting to get down under some of the higher volume too, under this, under 79, So if we see downside pressure, then yeah, I like that one. It's a short. I really do. Because you're kind of looking around. I'm like, look across a lot of large caps. I'm like, to be honest, some of the downsides here, I don't really love. Like the charts, like this is a glaring downside gap that, could provide some nice, cleaner price action as we start to get into that if we see further downside this week on the market. So keep an eye, but again, not going to sit here and personally for me, I'm not going to try to gamble out with overnight news, especially with the jobs numbers, the unemployment numbers, whatever, the jobless claims coming out tomorrow morning, and how we saw a pretty big reaction off of that last week. So it's like, if we saw a pretty big downside reaction that was bought up last week, what happens this week if we get a big upside, then there could be a better downside later on? I don't know. I'm going to wait for that to see what happens. Put call ratio on TradingView. I'll take a peek at that in just one sec. Let's see. Great with IWM and Apple puts, fill TTD and TWLO will go down significantly. Advertise it. Yeah, you know what? And that's not a bad thought too on the post-holiday season, like into next year. Advertisers probably going to be taking hits, a lot of advertisers probably spending a lot less money, I would guess, into next year, hunkering down and stuff like that, recession fears and all that good stuff. That gap looks juicy. Yeah, I like that idea. Look at the bearish shooting star in SPX. If we close like this, let's take a look at SPX and talk about the daily on that, and then we'll jump over to the put call ratios. Yeah, no, I agree. I mean, it doesn't look great. It doesn't look great. So if we get this, and there's a gap right here too, right? Like we talked about, I think 30 minutes ago maybe. There's this gap right here. Like I would love that if we got into that, provide nice downside. We start breaking down below 3,900, 390 on SPY roughly. There's a nice gap down into the 380s, something like that. Could be nice into the end of the week. And I wouldn't be surprised if kind of today's your consolidation day. It's what it seems like. Today is a pretty, minimal range day. We're going to end up finishing like down a little bit. Nothing crazy, it seems like, unless the next 10 minutes something crazy happens, which I doubt it. Not going to finish with much action. So you have that day to kind of, slow down some of these contracts that have been moving too fast. The VIX, mine's delayed. I know it's delayed by 15 minutes, whatever. The VIX on the daily is perking back up. So the VIX is starting to get a little interesting. And we kind of had a slowdown of that movement, the price action a little bit. It's not up as much as it has been the past 2 days. Put call ratios. I know this is not the easiest to look at, but yeah, it's been relatively high. Let's look at the past couple of days. Put call ratios have been perking up and higher lows, of course. And today especially, that was one that I didn't look at this until just now today. But that's pretty interesting. It's a pretty high number, up 1.2 plus. It's a lot of puts. So people are loading puts, people are playing puts. And in a day like today, your puts are kind of getting chopped. If you're playing puts today, outside of being very selective upon when you bought them and buying some of those relative highs, if you did well. But if you're if you're swinging puts out for a week or two, then they're kind of, we're kind of just in this chop and consolidation. They're kind of getting bled out a little bit with some decay. That's a little bit concerning. So we'll see. Again, is it a perfect indicator? No, we've seen how many times in the past this has gone even higher, or this has gone up high, and we've still gone down lower. But it's a good kind of to gauge where the crowd's at, and people are buying puts, seemingly, for now. Hella puts being bought, yeah. Yeah. Like to see more calls in the options market. And I was looking at some data. I think I saw some data recently, today or yesterday, that a lot of option premiums, I saw some bigger picture charts of option premiums, and they've come down in call option premiums, have come down a good bit. So they're pretty cheap, relatively speaking, compared to the past 10 years. They're pretty cheap. So we'll see. Line chart works a lot better. Yeah, I know you've mentioned that before too, and I agree with how it's a lot more confusing. But if you zoom this bad boy out, or you change it from candles to lines, to be honest, for me, it's as long as I got a good feel for where it's been, I've just seen that it's been relatively high. Anything over a 1.0, it's notable, pretty notable, and 1.2 is pretty high. It's not as high as it's been at times, but yeah. It tends to work. Like see the VIX close above 2260, and it's sitting there roughly right now as we speak on the VIX. 280 is holding on Qs. That's kind of my line in the sand on the Qs. I want 280 is kind of above that is okay. It's holding for now, but if we end up going below the 280 level, it's okay. It's not really great. We've dipped below it a couple times, but I want to see obviously a close below and a continuation move down will be more notable. So SPY a little bit of a so we said it looked like this right here looked like, here we go. We're breaking down to new lows. We're going to go to new low of the day. But if you chase that in a day like this, if you chase that, not that you got destroyed. It's not up that much, but it's up almost $1 from where the low was off of that. So we got that kind of fake breakdown look, and then a close just below VWAP is looking like what we're going to get. Lines on the daily. Let's look at that just to get a good feel for the put call. To get a good feel for where this has been. Yeah, it's up towards the highs of this year. Relatively speaking. I'm surprised we had this move down back in November. That was after the CPI. That's why everyone just slapped calls after CPI on That was about a month ago almost now. Jeez. Jeez. Let's see what else. Oh yeah, I'm gonna just check some of this. So I haven't looked at this in a bit. Put call ratio, 5-day average is also something that I've been watching like this year a decent amount. That's back up to, what was that, 0.9 now? 0.91 on that. And that came down, again, on the last rally in August, that came down under 0.8. Not that like we have to go down under 0.8, but like the lower that goes, like the better, I would feel about playing the short side. If this spikes back up, close to 1 again, on the 5-day average, like into like the end of this week, I don't know. Of course, CPI and Powell can essentially do whatever they want. It can completely throw things for a loop in no matter what direction, but it would not be the best, in my view, the best looking setup to be playing on the same side as like the majority, but hasn't been necessarily a terrible thing to do this year because a lot of people have been, option-wise, have been pretty bearish, and we've seen decent downside. Like this high right here on the put-call ratio in September, late September, like we still saw the market go to new lows after that. So it wasn't like that was the end of it. That was not the end of the dump. We went lower. So it hasn't worked perfectly. Downward level 390. Yeah, I would think so. 381 would be the gap back to the downsides. That's what I would looking for. That's what I'd look for if we do break down. And ideally, if today was a kind of a consolidation day and we start breaking down lower tomorrow and we don't bounce at all, then maybe we have another day or two of downside and people kind of panicking into CPI and into next week, and no one wants to hold over the weekend. Fridays have not this year, they have not been the best of days. They've had a couple of decent days in weeks past, but like into September and October, I think if we were looking at the stats, like the amount of red Fridays this year has been wild. So maybe that generally has kind of been like, oh, people are like, don't want to buy or don't want to hold stuff over the weekend, which makes sense. But we'll see if that pans out again. So there's the VIX popping up a little bit, but again, the VIX is funny, right? Where the VIX come down to? Around the $19 level, which has been the bottom from April, July, August, and then now here so far in November or late. Well, actually, no, December, we got into the 19 range. So every time the VIX comes down towards 19, it's bounced so far this year. The question is, do we get bounced back up to the mid-30s this time or more? That's where I'm somewhat skeptical. So stage is definitely set for for craziness into next week, right? Because with how the market's sitting, how the bond market's reacting, it's pretty wild times. For those who haven't seen that, here's the 10-year. Check out the 10-year the past like 6 months. Here's a 6-month chart of the 10-year. Down. I'm breaking down below 3.5. Probably comes to 3.25, 3.2 next, I would think. Unless we get a bounce off of CPI and Powell and whatnot, and it rips back up. CPI comes in a little hot, and that can change things, can change a little bit of the thought process here. A little bit. So let's see. What are we expecting? I haven't seen a consensus pop up yet. I'm sure I can research it further and get a better consensus. But it looks like forecast is still here. They're expecting maybe I would imagine the consensus will probably be pretty close to the 7.6 range, which is the trading economics forecast for the CPI for this coming report for November's numbers for the month of December. We're going to get in December. Now, how much does that play? How much does Black Friday deals play a role into that? I don't know. I was thinking about that the other day. Like, is that going to be factored in? I think it technically, right, it wouldn't it be factored in, but how much does that actually matter? Is that like, what are you going to get? How much of a downside could you see for November prices by Black Friday in things measured by the CPI? I don't know how much of an impact it really will have. And is not something that's like, it's pretty well known, right? I think everyone is well aware of that. So that's factored into forecasts, you'd think, and stuff like that. So we're going to see. 7.7 came in last report about a month ago. The consensus view is around 8%. So I'm guessing that we're going to be around a 7.6. If we come in, again, if the trend is continued to be down, right, in this 7.7 and we come in at 7.5 or lower, like, okay, the market's probably going to like that, you'd think. You would think. A Walmart short I have a Walmart short as a hedge. But let's check out Walmart. Is it up today? No, it was up at one point. Market's now closed. We'll jump over and check out how it was. I like this idea of Walmart. Here's the daily. Let's go to the daily or the year to date. It's been taking a bit to load here. I still like it. It's been trending down. I mean, I maybe my eyes are set for something too big here, but maybe this is a spot. Low 140s, 143 area, 144. Like there are $5-6 of downside. Can we get that? Maybe, but that's what I'm going to be looking for a downside on Walmart. I'm looking at this zone that I had charted out to be resistance a couple times over the past year or two. Overshot it, yes, earlier this year, but my stop out was this. And it's a hedge, so it's not like it's a massive situation or like, oh my god, realistically a hedge. I guess I shouldn't even have a stop. You in theory don't need to have a stop. It's either it goes to zero and that's it, or whatever. But I want to salvage some value, and if it rip up over that level, that would invalidate my thesis anyway on it. But so far, working pretty good. I got in. I didn't get the best average, but I got in somewhere in this white box, and we're up a little bit on it now. So that's my Walmart play. Holding one overnight on Walmart, but it's been a nice downside move over the past couple of days. Watch inflation come in at 7%. No, I mean, that's why I'm not going to gamble on it and bet on it, because again, if you look at it, what happens, and all of a sudden, that happens. And then the next day the Fed says something crazy that, hey, we're going to this is how you can kind of get screwed, where all of a sudden the market loves the CPI. And then the next day, instead of Powell coming out and saying that that's a good thing, he comes out and says, we're actually really concerned about a bigger recession. And we're not he says something along the lines of this soft landing is done. Of course, I don't think he's going to say that. It's kind of saying, it's kind of wild if he did. But if he said or implied stuff along those lines, that's how you can get a great CPI and then just get completely destroyed the next day because of Powell, and you kind of jump the gun, So in a perfect world, right, the CPI will probably tell us a lot about what we need to know anyway. And what Powell says is not going to necessarily be a huge surprise, number one, or number two, be that important if he's trying to, Siri's blowing me up. If it's clear that he's trying to walk back the move of the market. I don't know. He seemingly has been doing that this year. It seemed like on Wednesday of last week, that was far from the case. He was kind of chill and just hanging out and saying, hey, we got things under control, it seems like, right? And market liked it, and that was the deal, right? So we'll see if that happens again. But SWBI collapsed. Didn't have the other. Let's take a look. SWBI. Smith & Wesson. I saw you guys talk about this yesterday, I think. Oh, that's getting crushed. Oh, yeah. That is getting crushed. Check out the daily. Holy gosh. That's insane. That's a big move down. That is that. Talk about it getting destroyed for this past year. Past year and a half. My goodness. Yeah. But yeah, imagine inflation at 7%. Jeez, man, SPY will be at 410 in 2 seconds. If I feel like, and maybe we're totally wrong, but I don't know how much the market is going to be caring about inflation numbers versus the reality of the recession situation into next year and beyond, right? That's where we're kind of at in earnings and stuff like that. So SPY closing down 0.17% today, not much. Q's closing down 0.44, IWM, the Russell down 0.3, and the Dow pretty much flat. It closed down 0.02, but essentially flat on the Dow. So interesting stuff there. The 10-year was down. The 10-year yield was down 3.5% to 3.41%. The VIX is up a little bit. Dollar was down 0.4%. Put call ratio is up about a good bit. Look at this, notable today. XBI, biotechs, green. Healthcare, green. So those two ETFs. Here's a biotech ETF, kind of a trend line right here. This, you can look at a couple of ways. You know, I can see the chartist out here saying, oh, you got a cup and handle, right? Or, oh, you've got a, you know, potential, you know, channel that's going to break to the downside and we're going to go lower, right? I can see both scenarios. Just be careful, be cautious of both, be aware of both. Indicator convergence, the 200 moving average and the 50 are like right at the same exact spot that we're sitting at like right now at around $81. So indicators are converging, could be setting up for a decent move at some point, and you'd imagine that maybe next week is the time for that move. Up or down, really, doesn't matter either way. You know, we're going to get a pretty big move. You break this trend line to the downside, and you probably got some good moves to good opportunity down to the 70s. Dare I say, you know, towards $70. If this holds, then maybe you got up into the 90s here very soon on XBI. Only logging CAT, HON. You know what? I've seen a lot of people talking about CAT as a good option play. Feel like as of late. So let's take a look. Yeah, it's been pretty strong. Look at that, holding this 225 area on Caterpillar. I don't dislike that as a long maybe tomorrow. If we have a bounce day this Thursday, Friday for opportunities there, but it's up at resistance on the past year, so it's concerning up there to the 230s, 240 area. But just trying to hold that level. So we'll see if it does. Maybe I'll keep that one on the list for possible ideas into there if we stay strong this week. Downside though here is there's some glaring gaps. One right there, small one right here. There's some glaring gaps that this thing could potentially come back and fill at some point, but market's strong and that's not going to happen, at least now, if it stays strong. And this is just a little bit of a blip in the bigger picture. We'll see. But I can see both situations happening. I'm not like, there's a lot of signs that stuff is weak. Stuff doesn't look amazing under the surface. Apple, pretty weak. Amazon's, all the large caps are pretty weak. Small caps and mid caps, those are pretty weak as well. There's a lot of weakness. Dow names are the strongest names. Healthcare names pretty strong as well. As of late, bonds are doing pretty well, but I could see a situation where we have this pullback and it kind of suckers in, we'll see what happens the next 2-3 days. Suckers in some more shorts. We break under 390, suckers in some more shorts. There could be some great downside day trades there and great opportunities. And then CPI and Powell happen to be that, the good sign for a reversal, and we'll see. And that breaks the trend line, which, by the way, the trend line now comes down. So if we went straight up from here, we're breaking that trend line up around 406, 407 now on SPY. 410 will be a key spot, but that trend line, that true trend line breaks up around 406, 407. And then let's say a couple of days go by, next week or two go by and we break down below. And let's say, it's not till next year, some point next year, that we start to test this trend line again. That could be around $400, So just make sure that trend line will come down as time goes on. So keep that one in mind. So for a technical breakout, we still have to break this trend line, ideally, and that would still be, it's going to be lower and lower of a target as time goes on. Need to catch a falling knife could be a good hold. I think it's been funny to so far that a lot of the stuff that's just taken its time, oil and the bond plays, they've taken their time, but they've kind of panned out. So recessionary concerns based off of like leading indicators, bond market, oil, commodities, have kind of done what you would expect to see if we're going to go into a recession. Now we'll see if the bond market confirms that, because oil's coming down pretty hard. So we're going to see. But with that said, I do want to wrap things up. I appreciate all you guys for hanging out on the stream. We'll do one again on Friday. My bad, on Friday. And that should be the plan. So thanks so much for tuning on in. Again, links below for Chart Prime if you want to check out their indicators and that whole group. Sponsor, and thanks for them to sponsor the videos this week and last. And we'll see if how that plays out over time. But I do also just want to mention I do also pay for that stuff. So it's not like I'm just promoting some random stuff that they're just paying me to do. They are paying me to say that, but I also am paying for the platform and I have used it. So thanks so much, guys, and I will see you in the next video or stream. Wait one sec. Cameron Richard, do you think it's a good time to scale back into the market after being out? I don't think so at this trend line. My concern is going to be recession fears, and if we did break this trend line, like there might be opportunity. Like this could be some situation, right? And maybe there's opportunity there for better confirmation. But I think there truly could be better opportunities, into next year and beyond. That's my take. Again, what do I know? And if the recession it's a gamble, because if the recession actually isn't bad, then we could just kind of bottom out, maybe go to a new low relatively soon. If we go to a new low, then that's probably not a bad idea in my view to start scaling into longs again. Yeah. Are you going to have the same guy saying crash, 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 we're going to zero? Yeah, they're going to come out, they're going to be back, right? Just like they were back here, at these lows, just like they were saying it the past couple of days. Now that we're rejecting the trend line. Yeah. But can you, as an investor, can you be scared of that stuff? You got to have the longer term view. So for me, the way I've kind of done it to kind of not have to worry about it is I've almost essentially hedged myself. If you're going to do that, you can hedge yourself long with a TLT or a TMF is what I've done. Now I have a lower average, so understand that, because they've gone up they've gone up a good bit as of late. But these two things, or like TLT and then TMF is the 3X ETF of TLT. Like even if we see a recession and stocks go lower because earnings and whatever, right? And I mean, it's bad. This is in theory going to go up because that means the Fed is going to have to cut rates to get us out of recession or to kind of stimulate us back a little bit. And in doing so, yields will come down as they're cutting rates, as you're seeing the bond market kind of potentially giving us some signs now. And even if stocks go down, it doesn't really matter. This is kind of a hedge. This is kind of the way I'm doing it to essentially hedge that. And if stocks go crazy in the next couple of months, then I'm taking profits on some of that stuff for sure, just in case, especially if bonds keep going, yields come down and TLT goes higher, because that says, hey, that there's still probably a concern here. So that's kind of the way I'm going to play it. So it's not an easy answer. It really isn't. But hopefully that makes some sense. We could easily break down a lot more, especially what happens after next week. But if next week comes out and next week is good stuff, and market rallies hard, we break this trend line and start going higher, there could be some meat on the bone for, a little bit of an upside move. And you could potentially play off of for a few months or for a few weeks. That's my take on it. But with that said, we'll do another stream on Friday for Power Hour like usual. And I will see you guys in